Hello, traders! Today we'll break down a simple but powerful strategy using the Heiken Ashi indicator on the Bybit crypto exchange. It's a great way to filter out market noise and see trends the way big players see them. We won't talk about formulas or creators that doesn't help you make money. Instead, we'll move straight to practice: how to identify a trend, how to catch a reversal, and how to strengthen signals using the stochastic oscillator. First, let's cover the basics of Heiken Ashi. It's not a replacement for regular candles, but an overlay indicator. Heiken Ashi does not show the real price like standard Japanese candles. It smooths the chart, making trends clearer and easier to read. That's why for analysis we use regular candles and Heiken Ashi as an additional trend indicator, not the other way around. To add it, just search for Heiken Ashi in the indicators, and you're done. How Heiken Ashi simplifies trend reading? Regular candles in a trend can often be confusing. Green candles alternate with red ones. But Heiken Ashi removes this noise. A green candle with a large body and no lower wick means a strong uptrend. A red candle with a large body and no upper wick means strong downward movement. A candle with a small body and two wicks means slowdown. This can be a signal of a possible reversal. The key is not to look at a single candle, but at a sequence. But trends are not eternal, they weaken, and Heiken Ashi helps catch the reversal moment. You'll go test the strategy anyway. Follow the link in the description on the trusted Bybit crypto exchange to get maximum bonuses. Let's break down a pattern that reads perfectly on Heiken Ashi. Step 1. Find a stable trend, a series of green or red candles without wicks on one side. Step 2. A doji appears, a candle with a small body and two wicks. This is the first sign that the trend is losing strength. Step 3. Wait for two candles of the opposite color, each with a body and only one wick. This confirms the change in direction. As soon as the second opposite candle closes, that's your entry signal. Let's look at a real example. The price is rising, candles are green, without lower wicks. A doji appears, then one red candle, then a second, both without upper wicks. This is a sell signal. Or the opposite, a downtrend, then after a doji two bullish bars without lower wicks. This is a buy signal. Now let's move on to the second strategy, combining Heiken Ashi with the stochastic oscillator. The stochastic is like a market thermometer. It shows overbought above 80 and oversold below 20. But trading only by it is a mistake, because in a strong trend it can stay stuck in a zone and give false signals. Here, Heiken Ashi acts as a filter. Look for moments when the stochastic enters oversold territory, but Heiken Ashi does not yet show a strong downtrend. Candles are not consistent, bodies are small, and wicks are present. This means selling volume is weak, and an upward reversal is likely. Let's go through an example. The stochastic shows oversold conditions, but Heiken Ashi has not yet drawn large red candles. This means the market hasn't started an active move yet, and this is the best moment to enter. And vice versa, if the stochastic gives a signal, but Heiken Ashi is already drawing a series of red candles, the entry is already late. Let's break down how to avoid losing signals. First, don't enter based on the stochastic without candle confirmation. Second, don't enter if Heiken Ashi hasn't shown a change in direction yet. And third, don't trade against a strong trend, even if the oscillator is screaming about overbought conditions. If the video was helpful, don't forget to subscribe and write which indicator you'd like to see in the next strategy.